You mentioned, misperceptions about SPACs. What are the greatest misperceptions?
So we'll start with the biggest one that I battle with, and it's the nomenclature of SPAC versus de-SPAC. A SPAC is, at the time of the IPO issuance through completing a transaction. And what's most important about that period of time is you have a redemption right. So you can always get your money back, which is the trust account, usually $10 a share plus the accrued interest. And so when you're investing in a SPAC, you're effectively investing in a convertible bond that has no credit risk. Once the SPAC completes its deal, it now trades like any other equity security and can, trade low, trade high. I'll start there because it's important to know if you're talking about SPACs or de-SPACs. We mainly focus on SPACs and not de-SPACs. I would then say, the history of SPACs here is really important. So, when the boom took off in 2020, you had a lot of bulge bracket banks go to their high net worth channel and say, hey, you should raise a SPAC. We've got the best, M&A team, and so we'll help you find a deal and you'll make a tremendous amount of money. Don't worry about anything, just go. And so what happened, you had a lot of high net worth guys launch SPACs. People that may be very accomplished, but they weren't deal guys, they weren't financing guys. And I always say there's two things that make a SPAC sponsor successful. It's access to proprietary deal flow and capital. And a lot of high net worth individuals may not have those two attributes. And so they launch these vehicles, and all of a sudden the SEC changes its rules and says if you're advising on a SPAC transaction, you have underwriter liability. And all of a sudden a lot of these bulge brackets turn their backs on their clients. What then happened is you had this vulture phase where people would approach the SPAC sponsors and say, hey, I'll buy 80% of your SPAC for $1 and I'll bring you a deal. And so now you have 20% of something instead of 100% of nothing. And the problem there is you just had this huge misalignment of incentives where the cost basis was so low that if they did a deal and the stock fell to 25 cents, they would still make money. And so we had a phase of that, which is now kind of, cleared out. The pig is through the python, as they say. And you've had a return of these serial sponsors to market, guys that know what they're in for, understand the challenges and opportunity. And so, I think that the table is now set, like I said earlier, for some good transactions. But, there's no question that the memories of this past cycle have not been forgotten by investors. But they just need to understand that, the incentives were different when someone came in and has a cost basis of a fraction of a penny per share. And the incentives matter, right? The incentives always matter when you look at companies and management teams, et cetera. And so I think we're much better set going forward, but there's no doubt that there's some open wounds still from the 2021 cycle.